By now, you know that Tesla beat their delivery numbers and rose significantly this week. But did you know that there are other EV companies that rose even more than Tesla did? In today's video, I'm going to show you what other companies you might want to consider investing in that have the potential to outperform Tesla in the second half of this year. And because no stock is without risk, I'm also going to show you some of the downside risk that could push stocks down later this year. Over the weekend, Tesla reported 445,925 deliveries for the period ending June 30th, beating analyst estimates by over 20,000 cars. And Tesla stock rose about 7% on Monday in response to this news. But it's not just Tesla. Auto sales across the board have defied all of the gloomy forecasts. Years of pent-up demand and supply chain shortages, as well as high prices, have caused significant increases for automakers across the board. On Monday, Rivian shares jumped more than 17% after they beat analyst expectations on their deliveries. And XPeng reported a 27% quarter-over-quarter rise on their deliveries. And yes, I know companies like Rivian and XPeng have significantly lower deliveries than Tesla does, but again, it's all relative. So long as these companies continue to report higher than expected earnings, their stock prices are going to increase. And because stock prices of companies like Rivian and XPeng have not already doubled in price this year like Tesla has, they have a lot higher room to run up since they have not yet seen that huge run up like Tesla has. Meaning the second half of this year, these sorts of companies could actually outperform Tesla. And it's not just EV companies that are beating expectations. ICE companies such as Dodge, Durango, and Jeep sales pushed Stellantis second quarter sales up 6.4%. Even GM's second quarter sales saw an 18% increase over a year ago. So in looking into the second half of this year, consider some companies other than Tesla, since Tesla's already had its major run up, and start considering some of the other companies, both EVs as well as ICE companies, as these companies are all seeing significant increases in deliveries. Now, even though automotive companies are surging with increased deliveries, airlines are struggling. However, airline stocks are not struggling. Airlines across the board saw significant delays and cancellations due to weather as well as some FAA disruptions, and this generally would cause a significant disruption in profits, which in turn would cause stock prices to go down. But we haven't actually seen that. In fact, stock prices have continued to rise on airline stocks. United Airlines and Delta are both up 46% so far this year, while American Airlines is up 42%. The reason is because American Airlines and Delta Airlines recently raised their profit outlooks thanks to strong bookings, and lower fuel prices are also helping to increase profits. However, airlines are going to release their second quarter results and will offer a full summer outlook starting here in about 2 weeks. Those reports will likely include the financial impact of the late June and early July weather disruptions. And that means that airlines might end up having to lower their extremely lofty forecasts. And if that does in fact happen, we could see airline stocks start to fall. And this is probably the biggest risk to the stock market for the time being, is that after Q1, a lot of companies beat expectations, even though it wasn't nearly as many companies beating as what we saw prior to, say, the year 2020. Still, it was enough to push the stock market up. More importantly, though, even though Q1 earnings weren't great, a lot of companies had raised or increased their full year guidance. So now the question comes, can those companies maintain those elevated guidance levels going into the rest of the year? And based upon some of the leading economic data that we have, with hourly wages going down and consumer spending going down, it's very possible that some companies are going to have to lower their outlooks for the year. And ultimately, with rising interest rates, we all have to understand that companies simply cannot grow at the same rate that they did for the 13-year period when interest rates were near zero, with interest rates now running 20 times higher than they were just 2 years ago. The fact is, company growth is going to slow down significantly. You simply cannot grow your company when you're paying 20 times more in interest on your debt. And so we are more than likely going to be in a growth period that we saw from about 2001 to 2008, which is significantly stunted over the growth period that we saw from 2009 to 2020. Because with very high interest rates, this causes a lot of problems for companies. In fact, we've already seen a lot of companies, record number of companies, start to declare bankruptcy as well as default on their debts. And this is one of the next great crises that the stock market's going to have to get through, is the debt defaults and the issues with company debts. This is going to affect not only banks, but all companies across the board. Which means, because stocks ultimately are going to be priced based upon earnings, or more importantly, expectations of future earnings, the Q2 earnings, which start here in about 2 weeks, could be a catalyst that causes stocks to go down. So while the stock market remains extremely bullish and should continue to rise for at least the next 2 weeks, watch out for earnings season to start here at the end of July, which has the potential to end the current bull run that we're in. I'm not saying it will, it's just something you have to watch out for. Right now, though, with the market remaining extremely bullish and extremely greedy, the markets continue to ignore the looming debt pearl, which means stocks are continuing to rise. The fact is, decent businesses with solid cash flow piled on huge amounts of debt during the era of easy money and near zero interest rates, but now they face a reckoning. Rising rates make it harder to service the debt, and even steady, supposedly safe businesses can hit problems. And with a record number of companies declaring bankruptcy and defaulting on their debt, the stock market just ignores it and continues to go higher. It's hard to square a rise in stocks with the early evidence of debt troubles at the most leveraged companies, or those companies with financial history. Interest rates may yet prove to have teeth and may bring the stock market down in the future. And the rebound in interest rates is also putting pressure on banks. Now, normally higher interest rates are good for banks because they help increase bank profits. And we certainly saw this during the Q1 earnings. A lot of banks saw increases in profits. But the question and the reason why banks haven't really risen all that much is because there's a question that remains about the solvency of these banks and the impact that their debt load is going to have. While rising interest rates are extremely profitable for new debts, it makes old debt very risky. And we saw the risky old debt cause certain banks to be upside down, which ultimately caused the collapse of a number of banks back in March, including Silicon Valley Bank, Signature Bank, and First Republic. And unfortunately, those pressures might return. Unrealized losses on bonds and loans held by U.S. banks are expected to have grown in the second quarter, potentially reanimating the issue that made investors nervous earlier this year. Meanwhile, pressure on profits is rising as well. Unrealized losses should be pretty close to back to where they were at the end of 2022, when unrealized losses peaked at the vast majority of banks. It still feels like there's some liquidity pressure on the banks, although obviously the risk of an immediate failure seems to have dropped. But investors need to be aware that a resurgence of unrealized losses could raise fresh concerns about banks' health, and many lenders also could face deposit outflows and earnings pressure. And if banks do, in fact, show a decline in earnings, or more importantly, start to show liquidity issues again, this could cause downward pressure on the stock market, especially in the Dow and the Russell. The fact is, banks are borrowing heavily under the Fed's Bank Term Funding Program, but such loans, now at a fixed rate of 5.5%, must be repaid within a year. And this has caused some lenders, including PacWest Bancorp, to have been selling chunks of their loan books recently to boost liquidity. So be aware that while there are a lot of great opportunities in the stock market right now to make quite a bit of money, there remain a lot of risks. And most of the opportunities to make money in the stock market right now are in growth stocks, where investors believe that these growth stocks are going to continue to rise at the same rate that they did back when interest rates were at zero. Investors believe that growth companies are going to have no problem continuing to grow at insane rates, despite the fact that their debt is now 20 times more expensive than it was just 2 years ago. And if investors' beliefs that stocks can continue to grow at exponential levels turns out to be false, this could upend the entire stock market. And at this time, even though the stock market remains extremely bullish and extremely greedy, and stocks should continue to rise, you need to be aware that there are significant headwinds and risks in the stock market that could easily derail the current bull run that we're on. Now, if we get through all of these headwinds and risks without entering a recession, without more banks collapsing, without more major companies doing defaults, without more bankruptcies, if somehow magically everything fixes itself, then yes, we can continue to rally on to new all-time highs with no real concerns. But right now, I personally think the concerns outweigh the benefits. That is, the risk outweighs the reward. And I think there is a big chance that the stock market tops out here and starts going down once earnings season starts in about 2 or 3 weeks. So be aware that while there is money to be made right now, it is certainly getting riskier and riskier the longer you hold. You might want to consider taking some profits off the table, see how things play out with Q2 earnings, and then reevaluate after Q2 earnings season is over. So while we are bullish and we should continue to go up, just be aware of the risks, because no investment is 100% risk-free. If you got a lot out of this video, be a good friend and share this video with your friends and family. And don't forget to hit the like button and subscribe. And if you missed the last video uploaded, make sure you watch it here.